analyze, record, and post adjusting entries, prepare adjusted trial balance. In prior videos, we worked through the process of recording original transaction entries up through the creation of the pre-adjusted trial balance. We also discussed how to identify accounts needing adjustment. In this video, we will analyze, record, and post adjusting journal entries and prepare the adjusted trial balance. Another way of looking at this is in prior videos, we went through the process of recording original entries. Now we're going to go through the process of recording adjusting entries. In this video, we'll discuss the analyze, record, post, and prepare adjusted trial balance steps. After we completed posting the original accounting entries, we prepared the adjusted trial balance you see here. It's dated March 31st X1. However, this company decided that it wanted to report its results as of and for the period ended December 31st X1. So we'll just assume that we went ahead and recorded a bunch more transactions for the remainder of the year and now have the pre-adjusted trial balance as of December 31st X1. We now need to adjust our December 31st X1 pre-adjusted trial balance because some of the accounts are currently misstated. By going through the identification process, we were able to determine that some of the accounts are misstated. These items 1 through 20 indicate what we learned. We will now use this information to go through these one by one as examples of how to determine what the adjusting entries are, post them, and then prepare the adjusted trial balance. On this first example, I will take a little longer than the others, just so you get the rhythm of how it's going to work. In later videos, we'll go through quite quickly. Per the bank reconciliation, we noted that $30 of bank fees were not recorded yet. Thinking of the impact of those bank fees on the balance sheet equation, bank fees would come out of our cash, thus reducing assets. And because bank fees will have increased, the owner's equity in the business will have decreased. Step 1. Draw T accounts that represent the ledgers and enter the pre-adjusted account balances for each affected account. These balances came from the pre-adjusted trial balance, and I've entered them here for you to save you a little time. 2. Determine what the adjusted account balances should be. In other words, after paying $30 in bank fees, how much cash would you have left, and what would your bank fees for the year be, assuming you started with having no bank fees? The answer is you would have $30 in bank fees, which we would show by debiting it $30, and our cash would have decreased by $30 to a balance of $149,070 as a debit. 3. Determine the debits or credits that are needed to adjust the wrong pre-adjusted balances to the right adjusted balances. Bank fees need to be increased $30 and cash needs to be reduced $30. I've indicated below each of the T accounts what side is the plus side and what side is the minus side for each. Cash is increased with debits and decreased with credits, and bank fees are increased with debits and decreased with credits. A debit to bank fees will increase bank fees to $30, and a credit to cash will decrease cash $30. 4. Record the adjusting entry in the general journal and post to ledger. We'll debit bank fees $30 and credit cash $30. Now, having said that, this visual representation is effectively saying that we recorded the journal entry first and then posted into the ledger. This is just a little worksheet to help us know what the adjusting entry is, but I'm also going to use this as if this were the posting of the general journal. It may seem a little bit backwards, but this is the journal entry that's recorded first and then is posted into the ledger, as you can see here. Let's go on to some other examples. $600 of interest revenue not yet recorded. That would increase our cash assets and increase our owner's equity in those assets. The accounts affected are cash and interest revenue. The opening balance in cash is a debit of $149,070, which is the balance after making the adjustment related to the bank fees. Interest revenue has a zero balance at this stage. After recording interest revenue, we should have $600 as a credit, and our cash should have gone up $600. The journal entry, therefore, would be a debit to cash $600 and a credit to interest revenue $600. We've estimated that 3% of receivables is uncollectible. That means we'll have to reduce receivables by 3%. When we reduce receivables, the owner's equity will go down. We're dealing with these gross receivables of $15,000. We're saying they're overstated by 3%. Therefore, we need to reduce them using a credit. Now, we could put the credit here, but that's not what accountants do. They put the credit in a separate account called allowance for doubtful accounts. This is what's called a contra asset account. We increase contra assets by crediting them. On the balance sheet, the gross accounts receivable of $15,000 will be reported, but then they will deduct the balance in the allowance account to bring it to the net amount we believe is collectible. Therefore, if we take $15,000 times 3%, that gives us $450 that we don't believe we can collect out of these receivables, but it's just an estimate. As of the end of the year, then, we should show that estimate as a credit of $450 in the allowance account and record a related bad debt expense. The adjusting journal entry to go from the wrong numbers to the right numbers will have to be a debit to bad debt expense $450 and a credit to allowance for doubtful accounts $450. Now this example was quite easy because the opening allowance balance was 0. In future years, there may be a carryover debit or credit balance that we will have to deal with and will affect the adjusting entry that we record. Only $7 of office supplies remain in the closet. On our pre-adjusted trial balance, we show we had $500, but now we've counted the office supplies and there's only $70. Therefore, we need to reduce assets for the amount used up, and that will come out of owner's equity by recording an office supplies expense. The accounts involved are office supplies and office supplies expense. Our opening balance in office supplies is $500 as a debit. As of the end of the year, we've counted that there's $70 of office supplies remaining. That means we've used up $430, and that should be our office supplies expense for the period. What journal entry would take us from these wrong numbers to the right numbers? The answer is we would have to debit office supplies expense $430 and credit office supplies $430. The debit to office supplies expense increases expenses, and the credit to office supplies reduces assets. $12,000 of prepaid insurance represents a prepayment from March 1st, X1, to February 28th, X2. We've now used up some of that insurance because we're sitting at December 31st, X1. Therefore, we will have to reduce assets for the insurance we've used up, and that will be an expense that will reduce equity. The accounts affected are prepaid insurance and insurance expense. This prepaid insurance account is overstated because we've used up some of it. The only remaining asset is $2,000 because if you take the $12,000 prepayment, divide it by 12 months, and multiply it by the 2 months remaining that go into the year X2, there's only $2,000 of prepaid insurance that remains. We need to update this account to reflect that fact. The ending balance in prepaid insurance should be $2,000. And insurance expense for the year should be 10 months of insurance. So $12,000 divided by 12, that gives you $1,000 per month, times 10 months used up, $10,000. That should be the insurance expense for the period. How do we go from the wrong pre-adjusted numbers to the right adjusted numbers? We would have to debit insurance expense $10,000, thus increasing it, and credit prepaid insurance, thus decreasing it. Let's stop there for part 1. We'll have you take a quiz so you can make sure that you've learned the adjusting entries in this part. Then we'll move on to part 2 to wrap this up. We've just finished recording adjusting entries 1 through 6 on this listing. I'm going to stop this video here and quiz you on the material you've learned so far so that this video doesn't get too long. And then we will move on to the second part, part B, where you'll go through 7 through 20. By completing parts A and B, you'll know how to analyze the information related to adjusting entries, record those adjusting entries, post them into the ledger, and prepare the adjusted trial balance. Good luck on this Part A quiz.